In this video, we're going to look at the idea of spotting market turning points using divergence. I'm David Jones, and this week's video with Trading 212, we're going to look at maybe a different way of using oscillators. Now, if you've looked at markets and you've looked at charts, you're probably familiar with the idea of RSIs, slow stochastics, MACD, all of this sort of stuff. And plenty of these oscillators use the idea of overbought or oversold to try and figure out when a market is about to turn. I'm not a big fan of using them this way, I think, like plenty of other people, because you get lots of signals that can be fairly unreliable. So I thought this week we'll look at a slightly different way of using these oscillators. Now, because they're based on what the price is doing, broadly speaking, they'll follow the direction of the market. But it's when the market does one thing, but the oscillator might do something else, that can be the signal that maybe the trend is coming to an end. I think the best way of explaining this is to look at the textbook approach first. So let's have a look at the theory behind how divergences should work. As usual, let's start off with our theoretical market. The market pushes higher, trades to a low, rallies, and then pushes lower still. Let's see what the oscillator is doing while all this is going on. Normally, our oscillator is going to be following a similar sort of path to the market. So the market pushes higher, the oscillator may go overbought. The market sells off, the oscillator, because it's based on the market price, it's just going to follow the market lower into oversold. The market rallies a bit, the oscillator rallies a bit, but this is where we have the potential for the divergence. The market slips to a low, but our oscillator makes a higher low. So this setup here, where the market's made new lows, but the oscillator has made higher lows, this is known as bullish divergence. So it's a suggestion that maybe the trend, the downtrend here, is starting to run out of steam. Let's carry on with the market. So the market bounces back a bit, pushes higher, higher still, and has another go at breaking higher. Let's switch back to the oscillator. So the oscillator follows the market up, may go overbought when the market pushes to a high. The market pushes higher still, but if we get this sort of setup, where we've seen the market move to fresh highs, the oscillator make a lower high, this is known as bearish divergence and can be a suggestion that this bit of the trend is starting to run out of steam. So there we go, it works perfectly according to the theory. In the real world with real markets, it can be a little bit different, but let's start off with our first example. We'll have a look at pound against the US dollar. So what we have here, this is the pound US dollar. So it's a daily chart. Each of these candles represents a day's worth of trading. November 2016 through to the middle of June. So let's just see what's happened. The market has come off. So we've been up above that 130 mark, and the market spent what looks like the last 3 or 4 weeks just selling off. So we've pushed to a low, rallied a bit, pushed lower. Look what the RSI is doing. This is a 10-day RSI, Relative Strength Index. So the market pushed to a low, the RSI hit a low, the market rallied, the RSI goes up, the market turns down, and the RSI makes a new low. So far, this is exactly what we'd expect. But let's just walk forward a little bit in time. So I've jumped forward a few days here. Look what's different this time around. The market has rallied and pushed to a fresh low. But look at what our RSI is doing. Hopefully you can see there, we have got a slightly higher low. So this is the setup. This is the start of bullish divergence. So it's almost as if the RSI is starting an uptrend, even though the market is still in a downtrend. So an aggressive strategy, if we saw this, one way to give us a good potential reward versus low risk. When we see the bullish divergence setup, we want to be a buyer with a stop somewhere below that most recent low, because by definition, if this is a valid signal, the market should not slip any lower. It may take some time to turn around, but we shouldn't see that previous low. In this case here, just around about the 126 level, we shouldn't see that level taken out. Now, as luck would have it, this ended up being a pretty good example. This is where it was set up, and the market never really looked back. Over the next couple of weeks or so, we did get a move from here following the bullish divergence where the market went up to test those old highs. But that's a pretty good example on a mainstream market, daily charts, so you don't necessarily have to be stuck to the market all day long to see where this bullish divergence worked. So that one ended up being pretty much a textbook example, but I don't want you to get the wrong idea and think this works all the time. So let's take a look at another one. To demonstrate it doesn't work all the time, we're sticking with the same market here, and we've just jumped forward now, pound against the dollar, middle of July, and we're looking for bearish divergence. So where the market hits a high, RSI hits a high, the market pushes higher, but the RSI doesn't, and we've got the perfect setup here. Let me just highlight that. So looking at what happened, the pound is at a high here, trading up above 130, sold off a little bit, pushed a little bit higher, but look at our RSI. We've got lower highs on the RSI, so an aggressive strategy again here. We want to be a seller up here, the 16th of July at about 130.54 with a stop loss above the high, so that previous day's high. Let's see what happens next. Right, so I've jumped forward a couple of weeks, and you can see, okay, the market did sell off a little bit for a few days, but probably not enough to justify us moving the stop loss, and then the market turned around and blasted through that old high. So if our stop was in, we'd have been out for a loss, a manageable loss, but I think it's important to, to demonstrate that this approach is not some sort of holy grail that's going to work every time. So far we've looked at the RSI on a daily time frame. Let's take a look at a shorter term time frame and a different oscillator and a different market again. So for this example, I flicked over to a different market, the US 30, Dow Jones Index, different time period. These are hourly candlesticks and a different oscillator. This is the slow stochastic with a 10-6-6 setting. So this is the third week of August. You can see the Dow is drifting lower, so sells off pretty sharply there. Stochastic drops, market pushes lower, still hits another low, but look at what the stochastic's done. We've got a higher low on the stochastic. Let's just pick that up. So the oscillator looks like it's starting an uptrend, even on the market is still in a downtrend. Again, the aggressive trade would be to be a buyer with a stop somewhere beyond these lows. Let's see what happened next. The market did end up rallying. We saw a move of 250 points or so off this level. And I think what's interesting is that up here we have a bit of bearish divergence coming in. It's not the best example in the world, but I think in the real world it rarely is. So let's just pick up on that. So the US index set a high around about 21,800, pushed higher above 21,900. But the slow stochastic, you can just about see, has made a lower high. So again, the aggressive trade, be a seller with a stop above these highs, because if those highs get broken, the pattern looks to be invalid. And just for completeness, we can see the market did drift lower over the next sort of 12 hours or so. So there we have it. I think it's an interesting way of using oscillators rather than the straightforward overbought, oversold. As I always say, none of this stuff works all the time. It's really important to manage our risk when the trade doesn't work out as planned, but hopefully there's a few ideas there that you can use in your own trading, whether you're short, medium or long term. We'll start wrapping things up there, but as ever, if you have any questions or comments about what we've discussed today or anything you'd like to see in the future, just leave us a message in those comments down below. If you like the video, click the thumbs up, and to never miss out on any of our trading strategy videos, make sure you're subscribed by clicking the button there, and you'll get automatically notified when the next video gets uploaded. But for this week, we'll leave it there, and I hope you have a good trading week.